Mastering real estate investment strategies equips investors with the tools to align choices with their financial objectives and risk tolerance. This discussion includes 3 strategies: buy and hold, fix and flip, and the Burr method. Buy and hold appeals to those seeking long-term gains through rental income and property value appreciation. Success in this strategy depends on selecting properties in appreciating locations and managing them effectively. Fix and flip offers potential for quick profits through the purchase, renovation, and resale of properties, requiring accurate cost assessments and market timing. The Burr method, buy, rehab, rent, refinance, repeat, combines elements of both strategies, allowing investors to acquire distressed properties, renovate them, rent them out to generate income, refinance to pull out equity, and then reinvest in additional properties. Each strategy demands an understanding of key financial metrics, such as return on investment or ROI, and awareness of how economic cycles influence real estate values. These approaches provide a diversified framework for integrating real estate into broader investment portfolios. So I want to ask each of our panelists, since that segment video talked about different strategies like fix and flip or buy and hold, or the Burr method, buy, rehab, rent, refinance, repeat. I'm curious, what strategy has worked best for you and why? Chad, you want to start?
Well, the one that worked best for me was buy and hold, although I've done all of them. And when I first started, I started off as an entrepreneur, which I think is a little different than most real estate investors who have a full-time job and buy on the side. I got it out of college. I just jumped right into it. And so I needed to make a living as well. And so I think that's the main distinction, is that real estate is really a hybrid between pure investing and entrepreneurship in a business. Flipping is basically a business that takes this asset called real estate and it uses that to buy it low, sell it high. What I like about buy and hold, though, and the reason it's made me more money, is because I still own those properties. I kept them, and I'm more of a patient, long-term hold. I like studying Warren Buffett. I like trying to apply Warren Buffett's lessons to real estate, and I feel like some of the best investments I've had, they mature over time, and I find it easier to not have to pick when you get in and out of the market and timing and those types of things. Buy a good location, finance it well, take care of the property, and then you make a lot of money. And that's the simpler approach, but it also has been done really well for me financially.
Thank you. How about you, Russ? And maybe you can also mention the benefits of syndications in that mix.
Yeah, well, I think that at the end of the day, ROI is rate of return. Rate is speed, how fast. And so you can accelerate things through leverage. And that's really what the Burr method is all about. We called it in our book, Equity Happens, a free duplex story. The idea that you refinance equity out of property A and use it as a down payment in property B, use the tax breaks and the cash flow to control both properties. Of course, if you can force equity through that rehab component, you don't need to wait for the market to give it to you. You improve the rents. Equity is a derivative of income. And then you re-leverage the income back into a new loan and pulling that equity out. One property becomes 2, 2 become 4, 4 become 8, 8 become 16, call it breeding equity. So you can accelerate things that way. The other way to accelerate it is to bring other people along for the ride. And that is a super accelerator when you syndicate. So you raise capital from private investors who are very intrigued by the space. They can see what you're doing. They want to get in on the action, but they're busy doing what they do, running their businesses, making their living. They need the tax breaks, they need the income, they need the equity growth, but they don't have the time. And so you provide that service to them. There's some split of the profit, the cash flow, the tax breaks, and you get some fees for providing the service. So as Chad mentioned, it's a hybrid between putting together being an investor and really being an entrepreneur. And to me, it's the ultimate business opportunity because there is no limit to your growth. You can raise really as much capital as there is. And when you look at real estate and the nature of real estate, it's everywhere. And there's so many different ways to approach it in any market, in any economic cycle. As long as you don't pigeon yourself to a particular market or particular asset class or sub-niche of real estate, there's always going to be an opportunity and people who are interested in investing alongside you.
Crystal, what strategy has worked best for you?
Well, for me, it was a path of least resistance because what is one thing that we all need? We need a place to live. So why not have control of that? My first place was a duplex that I, lived in one unit. My mom lived in another. And then after that, when I had to move for a job, I kept that place and then rented out the other unit. And then after I was settled in my new location, I bought another place and then ended up renting that place out. And then I moved to another place. And it's just that was my path of least resistance. It was I needed some place to live, and then each time those places turned into a rental property after I decided, okay, I'm single, so it's easier for me to just pick up and move. So I've just picked up and moved and kept the previous place as a rental and rinse and repeat.
I like it. How about you, Joe?
Well, we did a March Madness style. If you're just beginning in real estate, what are the top 16 ways to get into real estate? Which one did this esteemed panel of guests that we have think was best? And so we just go head to head until we got down to the final one. And it was house hacking that won the day. So for people watching this that are brand new, and I totally 100% agree with that, getting into a house the way that Crystal did, and then hacking that residence, buying a duplex, you live in one side, or you bring on a roommate, some sort of a house hack, I think is the number one way to go. Clearly the one that I would caution people on the most is the fix and flip, because truly, if you're just starting out, especially, you might have a full-time career and you're trying to earn extra money. If you're somebody doing this on the side, a fix and flip is a job. And where I see people run into trouble with real estate is when they overcommit and they don't realize the time that it's going to take to do this, the team that you need to build, the equity that behind every wall, there's a problem, right? You don't know what that problem is when you first get in. And when I see people go to fix and flip at the beginning, it's horrible. The Burr method, to Russell's point, I think is a great way to build your empire. If you're trying to build an empire fairly quickly, my own son is about to turn 29 in a couple of weeks. He went from 0 to 14 houses fairly quickly using the Burr method. I think you definitely got to know what you're getting into there too. But if your goal is to get into real estate fairly quickly, the Burr method is a great way to go.
Russ, you mentioned using leverage as a way to increase your rate of return more quickly. Any advice on how does one know how much is too much? How much is too much leverage in borrowing?
Yeah, cash flow. I mean, you control the debt with cash flow. Really, an real estate investor's job is to manage debt, equity, and cash flow. The property manager is actually going to manage the property. You really don't have that much to do with it. You got to pick a great manager in a great market. But after that, you're really managing debt, equity, and cash flow. If you lose control of cash flow, you lose control of the property, the mortgage, and you lose control of the equity, and everything falls apart. I know because it happened to me. I got over leveraged in 2008 because I was feeding negative cash flow from a profitable mortgage business, and I wasn't making my real estate carry itself. So I got carried away with leverage, and it cost me big time. But if you understand that your primary responsibility is to magnify the inflation, in other words, if you get a 5% move on a property and you're 100% invested, $100,000, property goes up $5,000, it's a 5% gain. Okay. Real estate goes up 5% a year pretty consistently. May have some down years, may have some up years, but you put it in a blender over the long haul, it does that. Well, if you're in there with 20% down, now you're putting $20,000 down. That's you control 5 parts of property with only 1 part of down payment. It's still going to go up $5,000. And I think we all understand that $5,000 divided into 20,000 is a much bigger number, 25% versus 5. So you can accelerate your equity growth rate by introducing leverage. You control the leverage with cash flow. Your mission, your obsession, like any small business person, is cash flow. That's how you keep everything together. When the equity builds up too far, this is the Burr method, and the cash flow is built up, then you leverage the cash flow into tapping the equity to create a new property and just keep repeating the process.
And then with your strategist hat on, how important is it to be watching for the economic cycle?
Well, it's very important because your cash flow is a derivative of the economy. True investing is investing in productivity. Chad, I think, mentioned that he is a fan of Warren Buffett. I just actually taught a class last night. and was referencing the book that Warren Buffett studied to get started, The Intelligent Investor by Benjamin Graham. And the idea is that you're investing in productivity, not buy low, sell high, but cash flow, dividends. Well, when you invest in a rental property, you're investing in a business. You don't really think that way, but that person who is paying the rent is getting their money from a business. And so you're indirectly invested in that business. And so when you invest in a community, you're looking for a community that has a good supply of businesses and jobs, and you're indirectly investing in that by renting out to the people who are working in the company. And so if you look at it that way, then the economics, the local economics in particular, are very, very important. Some things are macro, like interest rates, credit markets, taxes, but some things in real estate are very local, like what's going on in the local jobs market and wages, and is it business friendly, and what are the property taxes and stuff like that. You have to look at both, but the economic component is very, very important to take into consideration when you're picking out a market and a property niche to invest in.
Chad, with a Warren Buffett approach, and you mentioned being a business person as a real estate investor when you got out of school, what are some of the metrics that you look at when doing that math?
Cash flow. Russ is talking about cash flow is always an important one. Although I think I've changed my tune a little bit on that. Like when I first started investing, it was, I've got to put food on the table. I was flipping properties. When I bought rental properties, I was thinking cash flow, cash flow, cash flow. But I found that like there's two different hats you have to wear as a business owner. The one hat is let's pay the bills, let's pay your, let's get the short-term things taken care of. But many people who are investing in real estate have a day job that takes care of that. So they wear another hat. And this is what I eventually learned, is that you have this long-term wealth building hat. And from a metric standpoint there, cash flow is important, but I think the timing of that cash flow is really what is not talked about enough. I see a lot of people looking at deals today in 2024, for example, and they're like, well, my cash on cash return is only 4% or 5%. So I'm not going to buy this deal. It's not a good deal because there's not enough cash flow. But cash flow is really a derivative of the financing on the property, and interest rates have been higher than what they were a few years ago. Cash flow also depends on the job and what people can pay. And so like I look at cash flow, but I actually look at one of my most important metrics is an unleveraged yield, is similar to like a cap rate. And it's for stock investors, when you look at like the earnings rate of a stock or a portfolio of stocks, I try to do the same thing with real estate, because that earning, that money that you're making from the rent minus all of your operating expenses, taxes, insurance, maintenance, that's really how good of a business this little investment is. And so some properties I look at in the best locations, I might want to have, for example, at least a 5.5 or a 6% unleveraged yield or cap rate. That might be a good deal for me. And I'm willing to wait on the appreciation to maybe make a 4% or 5% appreciation rate. And, 6% plus 4 or 5% might get me up to like a 10% total return. But then on another property, I might look at it and say, well, this whole market is kind of flat. I'm not sure it's going to do well over time. And as an investor, I might have to have a 8% or a 10% unleveraged yield to buy that property. So a lot depends on the risk of that location, the type of property you're investing in. But I like to simplify my investing by looking at just that as if I were paying cash for it, even if I am going to finance it. And I do like to use financing, but I like to look at it from an unleveraged standpoint, because that to me kind of equalizes the playing field, allows me to compare it to other investments, to stock investments. And, real estate's a little bit more active, a little more entrepreneurial. So if I can't get a premium to some of my more passive investments, like today, put 5% in a short-term bond, I always quote that and say, all right, if I can at least just make 5%, how well am I going to do on this real estate to do this extra risk, this extra work? And I can evaluate that premium at that point.
Joe or Crystal, anything to add before we move on to the next segment?
Well, I like the idea. I love this idea of the risk premium, thinking, how much risk am I taking to get this return? But I want to, I love Chad's analytics. I also love what Russell said about cash flow. What I think, if I'm thinking about like people watching this and people that are brand new to the area of real estate, wondering if they're going to get in, I think there's 3 metrics in particular that brand new people to this get wrong and forget. And the first one is your vacancy rate. People that are brand new to this just have this rosy idea, almost like I open a restaurant. I think the whole world's going to come, and it ends up being, the worst business anybody could get into is a restaurant. Same thing here. People go, oh, but that's a great place. It's going to be rented all the time. And to Russell's Russell's point, the economy goes south or anything happens. I mean, there's a million things that could happen. I need to be very conservative about what my vacancy rate's going to be. Second is renovation costs. As I said earlier, there's always something around every corner. I think that investors learn that with their very first rehab. If they don't get hit over the head with that sledgehammer, it's the second rehab that they finally go, oh, I need to, maybe double these numbers that it's going to cost to renovate. But then third, and because of people think about cash flow so much, I think that they also don't think about maintenance and upkeep of the property enough. And it's not the little things, right, that the tenant calls about. It's that in a number of years, it's going to need a new roof. It's going to need new siding. It's going to need whatever the big major issues are. I don't think we put the funds away from that. So I might not get into trouble 3 years from now or 5 years from now. I get into trouble when I really need to make this house pretty again, and I don't have the funds to do it because I've rated the treasury so much for this cash flow for me to live on.
And then really, really quickly, I was just going to add too, and don't fall privy or, to the buzzwords, because, people let the math tell you what to do, because of course people are like, oh man, interest rates are too high and blah, blah, blah. But when I bought that first house hack, interest rates were at, and I got an ARM, mind you, which was supposed to be lower, was 7.5% back in 2005. So imagine, if I would have said, oh no, interest rates are too high, like a lot of you would give anything to buy a house in 2005 because, it's worth a lot more today. So definitely don't feed into buzzwords or, oh, whatever is too high. Let the math tell you what to do. At that point, it was way, way, way cheaper for me to own that duplex. And I could have handled the mortgage on my own, because even that mortgage on the duplex was cheaper than what I was paying in rent. So let the math tell you what's affordable or what's a good deal, because there are a lot of good deals out here in high interest rate land.
Follow the math. Let's go to segment 2.